Tesla and Netflix just reported better than feared earnings this week, but they still lost over $60 billion in market cap between the two of them. On top of that, we got continuing jobless claims coming in at the hottest seen since December of 2021. And meanwhile, SPY only finished down by 21 cents this week, with the VIX at its lowest close since November of 2021. So, no fear in this market going into a big earnings week. Let's see what we have ahead of us. But first, let's talk about what happened last week. Last week on Monday, we had Barkin coming in and saying that he is reassured by what he's seeing in the banking sector, but he's saying that we cannot declare victory yet. So he's saying that things are definitely improving in the banking space, and they certainly have, with lending conditions improving ever since the Silicon Valley Bank mess back in March, but he's saying that we can't declare victory yet. So we can't just say that this banking mess is over. Instead, we still have to stay diligent, and another bank could collapse in the near future. And if that does happen, then VIX to the moon. But the 3-year Treasury bonds ended up getting sold on Monday with a new Treasury rate of 5.08%. So this means that the TINA narrative, or there is no alternative narrative, is kind of dead in the water. If Treasury bonds are paying you 5% and you're a money manager that's managing millions of dollars, then it makes a lot of sense to be pouring your money into these short-term treasuries that are going to give you 5% on your money versus putting it into stocks that are going to collapse in their earnings per share. Their price to earnings ratios aren't going to look as attractive, and their stocks may continue to fall. So this high treasury yield is working against the stock market if they continue to give these 5% yields. And then on Tuesday, we had Netflix coming in and reporting earnings where they beat their earnings per share marginally at $2.88 versus $2.83 expected, and then they missed their revenue barely, $8.16 billion in revenue versus $8.17 billion expected. And they added 1.75 million subscribers versus 2.06 million expected. So they didn't get as many subscribers as Wall Street was thinking that they would due to their new ad business. So I guess the ad business ended up being a failure in terms of what Wall Street was expecting. And then on Wednesday, you had Tesla earnings coming in and meeting their earnings expectations at 85 cents earnings per share, but they ended up missing their revenue marginally at $23.33 billion versus $23.37 billion expected. And their operating margin from last year in Q1 to this year in Q1 ended up going from 19.2% last year to just 11.4% this year. So the drop in their average sale price is really impacting their margins in a really big way. They ended up dropping the prices of the Model Y and I think the Model 3 by about 20% since January. So that cut in the average sales price is really putting pressure on their margins, bringing down their earnings per share. And if demand continues to slow down because of the high interest rates that we're experiencing right now, on top of Tesla vehicles still being quite expensive, then this is going to continue to weigh down on their earnings per share. It's going to continue to decline. On Thursday, we had initial jobless claims coming in at 245,000 people unemployed as of this week versus 240,000 filing for unemployment last week. And the expected was 240,000, the same that it was last week. So slightly higher than expectations, slightly higher than last week. And the continuing jobless claims came in significantly higher than expected at 1.865 million people total unemployed versus 1.82 million people expected. And this is up from 1.804 million as of last week. So more than 60,000 more unemployed people this week than there were the week before. And this is the highest continuing jobless claims that we've seen since December of 2021, where the unemployment rate was roughly about 4%. The last reading that we got for the unemployment rate was 3.5%. So it's going to be interesting to see what the unemployment rate is at the end of April. Also on Thursday, you got the Philly Fed Manufacturing Index coming in at negative 31.3 versus negative 19.2 expected, and this is down from negative 23.3 as of last month. So this is a significant decline in the Philly Fed Manufacturing Index, which is a precursor to a recession. If manufacturing is slowing down, they're anticipating that less goods are going to be expected and demanded in the near future, so they're reducing manufacturing ahead of time. And then on Friday, you got the S&P Global Composite PMI coming in slightly better than expected at 53.5 versus 52.8 expected, and this is up from 52.3 as of last month. So this is a good improvement to see for the Global Composite PMI, which is comprised of manufacturing and services PMI. So manufacturing PMI came in better than expected and actually a positive reading at 50.4. Anything above 50 is positive and anything below 50 is negative. So this came in at 50.4 versus 49 expected, and this is up from 49.2 as of last month. So this is a good improvement to see in the manufacturing PMI. If manufacturing purchasing managers are feeling a little bit more bullish, that means that manufacturing might start to pick up in the near future, which would help us out in this recession vibes that we're getting lately. And then services PMI, again, came in higher than expected at 53.7 versus 51.5 expected. And this is up from 52.6 as of last month. So the services PMI is still showing sticky signs of inflation in the services industry, which is what we're trying to work against with all the interest rate hikes that we've been seeing. But services tends to have more sticky inflation than goods. It takes a little bit longer for services to take the hit from these higher interest rates than what you'll see in the demand for goods, especially high-end goods like Teslas, houses, which we've seen a huge demand crush for. Also on Friday, you got the VIX closing at the lowest weekly close since November of 2021, coming in at a close of $16.77. So there is no fear in this market ahead of some of the biggest earnings names for this week. It's going to be a pretty wild ride either way. So that's your weekly wrap up. And for the coming week, we're going to have Coca-Cola reporting earnings on Monday. And then you're going to have CB Consumer Confidence on Tuesday at 10 a.m. expected at 104 versus 104.2 as of last month. So this is going to tell us how the consumer is feeling about the economy. And then also on Tuesday, you have a ton of earnings reports with Microsoft, Google, Visa, Pepsi, McDonald's, Texas Instruments, Verizon, Raytheon Technologies, and General Electric all reporting in the same day. So expect a ton of volatility for that. And then Wednesday, you're going to have the durable goods order coming in at 8:30 in the morning, where the regular durable goods is expected at 0.8% versus negative 1% as of last month. And then the core durable goods is expected negative at negative 0.2% versus negative 0.1% last month. And then the retail inventories also coming in at 8:30 in the morning, expected at positive 0.1% month over month versus positive 0.3% month over month as of last month. So if retail inventories are starting to build, that means that retailers are going to discount their prices in order to get this excess inventories off of their shelves. But if this ends up coming in negative, that means that they can raise their prices, and that would be inflationary. Also on Wednesday, you're going to have Meta, Thermo Fisher, and Boeing earnings all on the same day. I'll definitely be paying attention to Meta, and Thermo would be very interesting because Thermo's trading pretty high, and it is a sort of healthcare name, and generally healthcare names do better during a recession, but it's also kind of a technology stock at the same time, so it's kind of in this weird kind of mixture. We'll see how their stock ends up doing and how their earnings per share comes in. On Thursday, you're going to have the initial jobless claims coming in at 8:30 in the morning at 250,000 jobs lost as of this week versus 245,000 lost last week. And then the continuing jobless claims, or the total number of unemployed people, is coming in at 8:30 in the morning, expected at 1,865,000 or 1.865 million versus 1.865 million as of last week. So no change expected for the continuing jobless claims. And then the GDP is coming out in the morning at 8:30 in the morning at the same time, expected at 2% versus 2.6% as of last month. But this is just the preliminary release. The way that GDP is done is there's a monthly release, and then you have the official quarterly release once a quarter. So this is going to be one of the monthly releases, the preliminary report, which is basically just an estimate of what they think GDP is going to come in at the end of the quarter. So you're going to have the preliminary GDP coming in Thursday, and then Amazon, MasterCard, and Intel earnings on the same day. So a lot of volatility expected for the chip industry, and definitely going to be watching Amazon. That's one of the plays that I want to make this week. And then finally on Friday, you have core PCE coming in at 8:30 in the morning, expected at 4.5% versus 4.6% last month year over year, and then 0.3% versus 0.3% month over month. Personal income and spending is also coming out at 8:30 in the morning, expected at 0.2% versus negative 0.1% last month for income, and then for spending is expected to be at positive 0.3% versus 0.2% last month. So they're expecting personal income to come in slightly positive, better than last month where it was negative, and then spending to come in slightly higher than it was for last month. Also on Friday, you're going to have the Michigan Economic Report coming in at 10 in the morning, where the consumer expectations is 61.8 versus 60.3 last month. And then the inflation expectations last time was a huge surprise from 3.5% to 4.6% month over month for the 1 year inflation expectations. So this is definitely going to be something to watch on Friday. If it comes in even higher, that means that inflation is entrenched into the minds of the consumer, and inflation can be a self-fulfilling prophecy where people start buying goods now because they expect the prices to rise in the future, which adds more to the inflation fight. And finally, the last earnings you have on Friday is going to be a couple of energy stocks, ExxonMobil, Chevron, and then BYD-DY or BYD from China. So we're going to get to see how many cars they're delivering and how much money they're making off of that, if they can keep up with the margins that Tesla has been seeing with their Chinese-made vehicles. Then energy is definitely going to be moving on Friday with ExxonMobil and Chevron. And the three earnings that I'm planning to play for this week is going to be Microsoft, which is reporting on Tuesday after hours, where the earnings per share is expected at $2.26 versus $2.32 a quarter ago and $2.22 a year ago. And that historically they've done an average of $2.25 earnings per share over the last 8 quarters or the last 2 years. The revenue is expected to come in at 51.03 versus 52.75 last quarter and 49.36 a year ago. And historically, they've done an average of $48.63 billion in revenue for the last 8 quarters. The expected range for this stock is going to be $273 to $298 by the end of this week. And the support levels are going to be 286.46, 278.41, and 272.50. And then resistance at 288.94 as well as 296.28. I think if they end up beating their earnings per share and beating their revenue, their stock would be above $290. If they beat earnings, miss revenue, I think their stock would be above $280. If they miss earnings and beat revenue, I expect their stock to be above $275. And finally, if they miss earnings, miss revenue, I expect their stock to be below $270. I'm also going to be playing Visa this week, Tuesday after hours, where their earnings per share is expected at $205 versus $218 last quarter and $179 a year ago. And historically, they've done an average of $177 earnings per share over the last 8 quarters. The revenue is expected to come in at $778 versus $790 last quarter and $719 a year ago. And historically, they've done an average of $6.96 billion in revenue for the last 8 quarters. The expected range for the stock is 225 to 243, with supports at 232, 222.25, and 224, and resistance at 236.96 and 243. I think if they end up beating their earnings and beating the revenue, their stock could be above 240. If they beat earnings, miss revenue, I think their stock could be above 235. If they miss earnings and beat revenue, I think their stock could be above 230. And finally, if they miss on earnings and revenue, I think their stock could slip below $225 by the end of this week. And then for Amazon, they're reporting Thursday after hours, so a late report. But their earnings per share is expected at 26 cents versus 3 cents last quarter and 21 cents a year ago. And historically, they've done an average of 378 earnings per share over the last 8 quarters. So a steep drop in their earnings per share expected for Amazon. And they're only expected to make about $4 billion in net income for this year. So they're trading at like 250 forward price to earnings. So it's already expected that Amazon is going to have a bad earnings report. But on Friday, they were rallying like no other. They were up about 4% at one point on Friday. So people are starting to buy into Amazon ahead of their earnings report. But we'll see if that's sustainable. The revenue is expected to come in at $124.47 billion versus 149.20 a quarter ago and 116.40 a year ago. And historically, they've done an average of $122.97 billion in revenue for the last 2 years each quarter. Their expected range is $99 to $115 by the end of this week, with supports at $103.96 and $99.50, as well as resistance at $110.50 and $114.76. If they end up beating their earnings per share at 26 cents and beating the revenue at $124.47 billion, I expect their stock to be above $115. If they beat earnings, miss revenue, I expect their stock to be above $108. If they miss on earnings, beat on revenue, I think their stock will be above $104. And finally, miss earnings, miss revenue, I expect their stock to be below $100 by the end of this week. So those are the stocks that I'm watching for earnings this week. Let me know what you're watching. Hopefully this video was useful. If it was, show some love, leave a like. Thanks for making it all the way to the end of this video, and thank you to all my patrons and my channel members for their support. And as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys.